This episode is brought to you by Büro, our title sponsor. With 8 vibrant locations in Miami's best neighborhoods, Büro is the perfect co-working place to work, network, and thrive alongside other entrepreneurs, creatives, professionals, and local businesses. Find your space at BüroMiami.com. We're here at Bureau Central drinking, what was it, Nikka? Nikka, Japanese whiskey,
Yeah.
Q3 market update.
Yep.
The Brain Trust,
The Brain Trust.
Juan and Anthony.
Yeah. Excited to have you guys back here. This is, we do this quarterly, and it's been a real success. People love listening to you guys. I guess you guys have some sort of credibility in the market, so keep doing what you guys are doing.
You're making me laugh. I've listened to these two podcasts back to back, first quarter, second quarter. Now this is the third quarter, so we're third quarter. It's like geology. It's going so slow. So slow. What's changed since the last time? 2 grains of sand moved.
We really just use this as an excuse to hang out with you guys
There we
quarterly.
go.
That's what it is, and have a couple of
drink
drinks.
and enjoy. Yeah.
Fantastic.
Well, we're here with Anthony Graziano, CEO of Integra Realty Resources, and Juan Arias from CoStar. Juan, what's your official title again?
National Director of Industrial Analytics.
I love it. We're as some of our listeners know, we are Ben and I are brokers and focused on industrial, and so Juan just recently moved over to the industrial side, so it's our luck that we get to talk lots of industrial with Juan, and so. Here we are, Q3. We made some predictions last month or our last quarter, but wanted to dig into what is happening in the market. Let me pull up my list here, kind of give everyone.
I feel like Graz just summarized it. Nothing,
Podcast
over.
Well, cheers.
We'll do it again next quarter. Let's see if anything changes.
So just a quick recap. We got our 0.25% rate cut. The 10-year treasury hovering right above 4%. It's moving in the right direction. Stock market at all-time highs. I feel like every other week we're hitting a new high. Gold at all-time highs as well.
4,000 plus an ounce.
4,000 plus, and that's generally a hedge against, not a gloomy economic outlook. So things are moving all in the same direction, which is a little weird. But inflation is still ticking up, I think. My wife was at Costco last week, and I'm going to trust her just because women tend to do the shopping. She says all the shit at Costco is getting really expensive. Employment is stagnating. At least that's what some of the headlines say. Dollar is down by 9% against a basket of currencies. The Economist is forecasting U.S. economy will grow by 1.5% to 2% in 2025. And I thought this was also an interesting statistic from The Economist. Every year since 1930s, more people have arrived in America than have left. In Biden's last year, net migration was 2.5 million people a year, and that figure may fall to 0 or even turn negative this year. Yeah. We want to talk a little bit. I think we're going to lead with industrial just because we're on the industrial side too, and we can share a little insight on what we're seeing here locally, and then kind of want to really talk to Juan on what he's seeing. I think, and at Graz, I don't know if you disagree with this, but it seems like industrial is kind of an early indicator of what is happening in the economy. It seems like, what we're seeing in terms of freight and rail and warehouse storage, these are all indicators of where the economy is headed. So for lots of reasons, we're going to start with industrial. On our end here in Miami, we are seeing transaction volume decrease in the markets that we're focused on, which is Alapata, East Hialeah, West Hialeah, Opalaca, Golden Glades. But I think, that's pretty much all markets in Miami are probably feeling the same thing. Lease rates, especially for the big stuff, and we're saying 75, 100,000 square foot warehouses, are definitely stagnating, if not declining. The warehouses, smaller footprints, especially the small bay, multi-bay, seem to be holding steady still. But we're not seeing the appreciation that we have been seeing over the last 5 years, and that is, we're not seeing downward pressure on the small bay stuff, but that's probably the next shoe to drop, is what we feel like. So let's start with Juan. Talk to us about industrial from both a local, 305, 954 sort of South Florida view, and then what we're seeing on a national level as well.
Yeah, so we'll just look at some of the leading indicators, right? So the leading indicators would be kind of pricing trends for containers moving out of Asia and into the West Coast ports. Typically, they're a few months ahead of the container flows that we actually end up getting. And we had those kind of ticking up before the summer significantly. And that was kind of leading into an increase in container inflows into the West Coast ports from Asia, as a lot of shippers were trying to get ahead again of another, of the volatility in the tariff environment. So we had that uptick in containers coming in throughout the summer. And now over the last month or so, we are seeing pricing trends go south significantly. Which is implying that the second half of the year, we're going to see a significant moderation in container flows moving in, particularly from Asia into West Coast ports.
And you're talking number of containers, and what is the cost per container to ship?
The cost per container, I forget the actual level of the number, the actual level, but it could be like $3,000 on a normal market. Then it drops below $2,000 when we see some significant weakness, and I think we're there right now. So that kind of leads to a drop in container inflows,
and that happens because there's excess capacity in the logistics market, right?
Yep.
So it's a mix of things. So part of it is you get an uptick in container pricing when there's a lot of demand, but keep in mind that the shippers and the shipping, the big shipping fleets, they're aware that they're very quick to react to these trends. So they will add lines to certain markets that they want to service, and that will help with capacity. So what they do when pricing ticks down significantly is that they will enact blank sailings. And that's what we've been seeing over the last month or so. Blank sailings, meaning that the ship doesn't sail out of the port because there is no demand for it. And even with that readjustment in capacity from the shippers, the pricing just ticked up slightly, but there's no real demand coming in right now because everybody front-loaded their imports through the summer, second half of the year. And if you look at the National Retail Federation and the guys that project what's going to happen with freight, everybody's talking about second half of the year it's going to be low, right? Because everybody got their stuff in before then. The other point that I like to make is we're not really surpassing highs in terms of import activity that we saw in 2021 or 2022. So, the Port of LA was kind of one of the ports where we saw a 1.5% increase in container inflows relative to their highest level. So there was a little bit of an uptick there. But if you look at all the West Coast ports combined, we're not surpassing prior peaks in containers coming in. Meaning that there's no real growth in the goods storage demand side of the equation, and that if you look at rail car loads, they're not surpassing. They're coming up, right? Because containers are being placed on rail cars from West Coast ports into those rails, into those trains, and then shipped into Chicago, the East Coast, etc. So we saw kind of a gradual uptick in container rail car loads, but they're not really surpassing prior peaks either. So both from what we're seeing in the ports, in the rail car loads, and then if you look at loaded trucks coming in from Canada or loaded trucks coming in from Mexico, they haven't fallen. They were falling a little bit at the beginning of the year. Now they're not. They've stopped that fall, but they're not growing either. So on the freight side of the economy, we're not seeing growth from prior peaks. And that just means the amount of goods that are flowing in, it's not going to increase the capacity, increase demand for more large warehouse storage, because the retailers, the shippers, they don't need it right now. And based on consumer trends, if you look at real retail sales growth and real e-commerce and non-store sales growth, they're okay. They're growing, but they're not growing at like stellar levels right now. So the consumer's holding up. It's not terrible, but it's not growing at a level where like these shippers really need to load up on inventories because they see that the consumer's going to be spending a significant amount of money later on, right? So they've loaded up on the goods they need. They're keeping inventory to sales ratios at around 1, and they're ready to just offload these inventories into the second half of the year.
Is that just a healthy market, or like what's a normal? Because you can't have crazy growth all the time, right? It's
right.
Gotta be...
So I mean, the logistics market really extended itself coming out of the pandemic, right? The e-commerce firms, the 3PLs. Everybody was absorbing space wherever they could find it. If there was a space up for sublease, they would take it. If there was a building that was going to get delivered in 6 months or in a year, they would pre-lease it. All those data points have shifted over the last year or two, in which we're seeing, sublease availability tick up higher, sublease rental rates fall, and they're like a 20% discount now relative to direct rents. The pre-leasing of mid-sized logistics space has trended down. So the occupiers of big logistics space are in a kind of a right-sizing moment, which they have been in for a while, and they're rethinking, okay, how do I optimize the space that I currently have? How do I relocate to more centralized areas and serve more markets from lower real estate footprint? So we're generally seeing a lower lease sizes being signed for anything greater than 100,000 square feet. That's fallen from over 200,000 square feet down to 160,000 square feet on average over the last year or two. And then if you look at clear heights, they're going up in clear height, but they're going into smaller spaces, right? So they're signing less amount of space, and they're vacating maybe the older properties, moving into the newer properties. So that's not really generating much positive net absorption in the industrial market right now. So if you look at our Q2 data, we had the first negative net absorption reading for the industrial product in 15 years.
Nationwide.
Yeah.
And to your point, Felipe, like you mentioned, the bigger space is 100,000 feet. So in the industrial market, the bigger spaces really start. We talk about 500,000 feet, 300,000, 500 is the starting point of the bigger spaces. Some of these warehouses are 1 million square feet plus. In most of the markets around the U.S., that spec building stopped 1.5 years ago, and yet there were deliveries. And therefore, there is excess capacity out there in that 300,000 to 500,000. That's really the concern. Is that, does that look like a 12-month lease up anymore? No. I mean, when it was probably pro forma, people were thinking, 12 to 18 months, because there were so many people sort of taking up that excess inventory in advance of when they needed it. And that has largely stopped. And so now you have this sort of game where everybody's looking around saying, okay, now that 2-year lease up or 18-month lease up might be 4. And now that's affecting those investments. And I think largely nationwide spec building is probably out.
Yeah, I mean, Prologis in their latest earnings call, they basically mentioned that they're pulling back from spec buildings significantly.
Yeah, and made a big announcement on where they're going with data centers, which means they don't see the growth in industrial either, right? So if Prologis is going to move into data centers, then you have to think like, where are they seeing the opportunities for growth? And they're saying, we've got to diversify. Right. So that'll give you a hint that, hey, the industrial market, we know that the pricing. I had a conversation with a good friend of mine. He's an industrial broker, and we were reminiscing about our careers starting 30 some odd years ago. I said, you remember when the office brokers used to be the big dogs because they'd sell a building for $300, and you were a dumbass because you used to trade buildings for $40, $50 a foot. You were like the low end of the brokerage totem pole. And now, like, you're trading industrial buildings for $300 a foot, and all the office brokers are begging for $30 a foot on the suburban office buildings. So now you're the big dog. But it's things go in cycles, and certainly I think the industrial market, and we talked about this, I think the last time, like, I think it's priced to perfection. It's not, falling off the map, but certainly we're starting to see, fundamentals change in the industrial market that is going to slow that and slow pricing.
Felipe and I are back with another new event. We got sick of getting over caffeinated in the morning. We needed to balance it out with some cocktails. Yeah, as you guys know, we're doing a little Built World After Hours event. Yeah, we thought it'd be another cool way to do a compliment to the Cafecito Club that's been getting a lot of traction. Hang out, unwind, talk to Bob Knackel, the legend of New York City building sales. And we'll be at the Central Bar in the Miami Central. You can't miss us. See you guys there. Cheers. Is this just a return to baseline normal, or is this more of a structural shift to something else?
Industrial's grown so much over the last 10 years. I don't know what you would. We're not going to go back to $50 square foot industrial buildings,
right,
if that's the question, right? But they shouldn't be $350 either. So I think we're going to start to see some retrenchment in pricing on those industrial buildings, in correlation with leasing, but they're not going back to 50 or 60. So if you say, are they going to revert to the mean? No.
So where data-wise, where we've seen the weakness in pricing is in the large logistics that is vacant, right? So big boxes that are sitting vacant for a while, they're beginning to trade at a discount. While if you have a big box that is fully occupied with
no
probably
discount.
no real discount, no pricing growth over the last couple quarters, because they're really that there hasn't been much rent growth feeding that pricing growth, or significant cap rate compression. Cap rates are flat. But no, the prices aren't falling off for if you have a stabilized large logistics asset. If you have one that's vacant, well, you're now struggling, right? Because there's a significant supply overhang from whatever the pipeline that was left over, right? That's still delivering. And, the industrial players there, they want to say, no, construction's coming down significantly. Yeah, construction has come down significantly, but we're back to 2015 levels in terms of construction. And still the 90% of it is concentrated in 100,000 square footers, logistics properties, right? And now that we're seeing sublease availability tick up higher, and not just for older properties, we're seeing it tick up higher even for 2010 plus built 100,000 square footers. So that's competitive, new, large logistics space that is adding to the supply overhang that was still coming in from that supply pipeline, right? So that 100,000 plus square footer that you wanted to sell and lease up in a year or 18 months might not be as attractive anymore, right? So that's where we're seeing that pricing discount begin to happen. When you look at the small bay stuff, it's kind of weird because there's a little bit of inversion in the story where if you look at small bay, the stuff that's not leased and going through some tenant churn actually gets a little bit of a pricing premium.
Juan, just when you refer to warehouses as small bay, what's your definition of small bay?
So I've been generally using anything that falls below 100,000 square feet, but it's logistics space specifically. But the outperformance I'm really seeing right now is below 50,000 square feet.
Yeah.
So 100,000 is below is okay, but then 50,000 square feet, that's where we're seeing rental rates hold up the best and leasing activity hold up even better. So yeah, really small industrial, right? So that's where pricing is holding up. That's where you still can, mark to market rents from 3, 4, 5 years ago and increase those rents as tenants roll over, right? And that's the only juice you're getting right now in terms of rent growth when cap rates are not compressing, right? And the expectations giving, the 10 years still above 4, we're not expecting a significant downtick in cap rates in the next couple quarters.
And riffing on that back to South Florida, let's talk about that. So if you're defining small bay as less than 50,000, which is, I think a fair definition, the other reality is we haven't built a bunch of it.
No.
We had a lot of overhang, so there's been no excess construction in that 25 to 50,000 square foot range of industrial buildings. And that's not just a South Florida phenomenon. That's most industrial areas around the country. But I will say that Live Local has added a bit of a twist, right? So the ability to repurpose these industrial buildings and buy a building, small bay building, and demolish it and build 600 units is evident. So the other thing is, beyond the lack of construction, we've also seen a consumption of the industrial land.
Yep.
Yeah.
Right? We've seen a lot of industrial land repurposed, which means we're demolishing buildings. We're not building new buildings. And so what's happening is we have a supply constraint on the small bay side where that's keeping up, that's holding up the pricing.
Yep.
Right? And that's good to one extent. But the other reality is it's very hard to get industrial zoned. You know, you go into a community that is deficient in their industrial zoning, and you try to get industrial zoned, and the public outcry is substantial, right? So it's a long tail to fix that supply side on the small bay. And if we're going to keep demolishing and the buildings are getting older, there's going to be a point where there's going to be a spike in that. And I think we're starting to see the early signs of that. That's
A spike of what?
a spike in pricing for the small bay.
I
mean, look, and you know, we talk about values, right? But I mean, some of this large scale distribution warehouse stuff, just because construction costs have come up, land costs are elevated, you know, those are trading north of 200 a foot. The small bay hasn't been, you know, because some of the, I'm excluding the condominiumized product, but you know, most of that small bay stuff was trading at below, you know, significantly below replacement cost. A combination of being older, but also a combination of demand.
Ben, you know what they say in real estate, if people don't know you, they're not doing business with you.
Exactly. That's why the Built World podcast works with top of mind public relations, because being a best kept secret sure doesn't pay the bills.
Paula Uspa Abbott, the brains behind Top of Mind PR, is a former real estate journalist, so she knows exactly what makes the media pay attention.
And let's be real, getting in the press isn't just about bragging rights. It's about building credibility, landing deals, and making sure the right people know your name.
Whether it's top tier media coverage, killer storytelling, or just making sure you're the one people think of first, Top of Mind PR has you covered.
Want to stand out? Hit up topofmind-pr.com or email info@topofmind-pr.com.
Because in real estate, if you're not visible, you're invisible. Ben, you and I are all about PropTech, and if there's one tool we absolutely cannot live without for our commercial real estate brokerage business, it's Vista.
Absolutely. Vista is incredible. We use it every single day, and we're always wondering, how do they do this? Every evening we get an email from them with real-time closed transactions. No more waiting around for months for the property appraiser to finally update.
Yeah, whether you're doing industrial, retail, office, land deals, they have every closed transaction. And it's not just the speed, Ben. The details are on point. Seller and buyer info, contact details, phone numbers, emails, everything is accurate.
It's hands down our top prospecting tool to farm for warehouse deals in Hialeah. Vista keeps us one step ahead always. It's also the best way to search for comps when putting together opinions of values for clients.
Head on over to Vista.com and use code BuiltWorld and get 30 days free access today. VIZZDA.com.
We're seeing the strongest small bay, like really small bay, like we're talking like multi-bay, like 2,500, 3,000 square foot multi-bay properties. Mm-hmm. Those are getting the highest rents.
And that's where we've seen
in where we're seeing
most of the search patterns from tenants. They're the bulk of activity where we have seen some increase is anything below like 5,000 square feet. That's in industrial.
The problem though is no one will sell. Like,
so that's
no sale pressure.
Right. So I think, look, this is a market that will be undersupplied for years to come. For every 100 square feet that gets built, 30 or so square feet get demolished in the small bay, right? So it's still generally going away. And that's nationwide. So supply constraints will be there. There's higher and better uses for a lot of these. So it's very attractive, but then the amount of listings for sale for anything below 100,000 square feet, they remain well below pre-pandemic levels. While if you look at anything above 100,000 square feet, they have now ticked up above pre-pandemic levels. So sales listings, there's a lot of stuff for sale above 100,000, and a lot of it is vacant. Below 100,000 small bay, there's just not that much to go after. And that helps on the pricing side, because you have all these players that, okay, well, I can't play big box right now. There isn't much there right now. So everybody targets the small bay, and you have 5 to 10 bids for one small bay asset. And the big guys, institutional players, are targeting that as well, right? So the pricing might be, in those deals, it might be getting to perfection as well.
Yeah, the other thing I was going to mention on Anthony's thing is the live local thing. A lot of sellers think that way. They're like, oh, you can build 300 units here. And I'm like, great. Where's the revenue coming from? There's no rent comps within a mile, 2 miles of you. Like, there's no way to justify development here. I can't tell the bank that I'm going to hit $3, $3.50 rents that I need to hit to get the yield on costs I need to hit. So it's kind of this like, it's a really hard thing to make work. It's got to be close enough to other rent comps to where you can make the argument that these developments make sense. But to your point, the sellers have this idea that you can build a giant tower here and make a ton of money.
Yeah, I mean, I had that question the other day from a client. He said, how much of the has live local affected the values? And the reality of it is, if you think about that, it's not going to affect the values, because every community has the same opportunity, right? It's not property specific. You're not getting an upzoning on a specific property, and then you say, well, now I've got this asset that nobody else has. Everybody has the opportunities here for the same density. So the buyers of these live local sites are not being driven based on unit count per se, and then going in and buying an industrial because they could get more units. The sellers' expectations around that are unreasonable. So I'll qualify that. I'm just talking about the impact. I mean, we're in the process now. I mean, Miami-Dade County, I think their deficit is about 75,000 units. And we've got 25,000 live local units under construction and planned. So, and much of which has been in industrial zones. So, and there's a lot of assemblage of older industrial areas,
especially east of 95. Yeah.
Right. So you look at some of these areas that historically have warehoused a lot of these smaller units. They're being aggregated by the developers for ultimate development. My point is, we're going to start to see supply continue. And I mean, Juan said it best, right? So for every, whatever, what'd you say, 100 feet, 70 being demolished, it's a 30% net decline in the amount of inventory that's out there. The flip side of that coin in terms of pricing and fundamental demand is what you were talking about, Ben, like the 2,500, 3,000, 5,000 square foot bays that are in these multi-tenant buildings. If you look at what that tenant profile looks like, that's a lot of contractors. Right, it's a lot of plumbers, a lot of HVAC people. Auto repair. Auto repair is hard because they don't normally have the parking. But the point is that it's a lot of the blue collar jobs that are living in the economy and need a place to warehouse their goods. In a weaker economy, those don't hold up, right? Because you see a lot of people having to downsize and cut overhead and do things. It's while the economy is good, those things look like they're ripping, but they do whip back in a weakening economy. So what's the larger economic context here? Is the economy going to weaken? And then if so, there will be some backlash on rents and demand in that 2,500 to 5,000 square foot base space.
Great
and
point.
We're seeing that in a lot of other markets. Not in Florida for sure. But
so I'm going to put our job onto you guys. How do we make money in industrial these days? Where's the opportunity?
Get listings. I don't know. find willing sellers.
There's
identify
none.
willing
Very
sellers.
Very few.
Yeah.
No one's over levered. No one really needs to sell. The few people aging out are typically the sellers. Some mark-to-market issues, but it's slim pickings out there.
I'm surprised though that the profile for the owners of those types of buildings, there should be some natural churn in the generational transfers.
There is, yeah, there certainly is. But we see the transaction volume dropping, and then we're kind of assuming prices will be not too far behind. Hopefully,
yeah,
that's typically what happens, right? You see the momentum or the volume drop off, and then pricing kind of follows.
Ticks back down.
Starts to tick back down. But we just haven't seen the pricing follow the momentum yet.
Yeah, and again, large scale trends. I think people listen to different things and then they make decisions based on these macro trends. I think a lot of the reason that people are unwilling to sell right now is they're looking at replacement cost and they're saying, "Hey, this is going to keep going because the tenants are full. I've been getting great increases, and nobody can come in the market because you can't acquire the land, entitle the land, and get out of the ground with a small bay deal feasibly." So I'm in a great spot right now, but that doesn't last forever. And so I think part of the broker's job is to understand what's your risk adjusted long-term play. Are you in this for 5 or 10 years? Because it'll go down and it's going to come back. Are you willing to wait for it to come back, or do you want to maximize your opportunity? Because it's right now. Some of it is just where are you in your investment life cycle? And I think where you can convince sellers that, how's it going to get any better than this? That's usually when you get them to sell.
Love that.
Best time.
I agree with that. I mean, I think we're topping off the top of the market right now.
For sure.
You know,
I mean, it's been a 5-year run up.
Yeah.
We've seen lease rates and sale prices about double in the last 5 years.
Yeah.
So
and some of it too is experience, right? I think if people, I talk to my daughter about stock investing all the time, but her whole experience has just been, she can't lose. She thinks she's the smartest person in the world.
Up and to the right, baby.
Baby, up and to the right. But I think it's the same thing in real estate. I think some of these generational real estate owners, have sort of looked at it and said, I love my return on real estate, but they don't ever think about the squeeze.
I have
we're in the midst of that.
100%. A great story from a friend that works at an investment bank. He was up late one night working on spreadsheets, big New York firm, and doing some deep risk-adjusted analysis across types. And one of the clients of the bank was walking through the trading area, and it's a billionaire, this guy. Walks up to him and he's like, "What are you working on?" And he's like, "Oh," he told him like this, detailed spreadsheet on risk-adjusted returns. And the guy's like, "You don't need to do any of that. When the line goes up and to the right, it keeps going up and to the right." And he walked away. He's like,
Exactly.
Momentum, baby.
My dad always used to say, it's better to be lucky than good.
100%.
Any day.
Should we switch to overall macro picture?
Yeah, I think we should.
That was a deep dive on industrial.
Yeah, that was great, guys. That was awesome.
The first thing I noticed on your charts that you sent over, Juan, was the population growth shift, mainly because that was slide number 1. But
Wait,
also,
time out. He sent over charts? I didn't get to send over charts. When do I get to send? Should I be sending you charts?
it's up to you.
Oh, damn it. All right, I'll do that next time. Fourth quarter, you're going to get a load of charts from me.
Oh, yeah.
They're all going to be CoStar charts, but let's not talk about that.
Yeah, copy paste from our articles and stuff.
We go straight to the well. Guys.
What I was gonna say is all the population growth since 2020 has been international rather than domestic in terms of net gain.
Yeah.
Nationwide, not in Florida.
Well,
I think it was Florida, wasn't it?
In
as
Florida
well.
too?
Yeah. So something that, the market really likes to state, which is, we had all this net domestic in migration. But if you actually look at the data, both historically and after 2021, we began to see kind of international net migration drive that population growth in Florida and nationally, right? So 80% of the population growth across most counties in the country and in Florida was coming from international net migration since 2020, right? So 2021 was a blip because international borders were shut down. But the population growth for the U.S. as a whole, historically, comes from international migrants, right? So it should not be a surprise that once borders opened up again, the international net migration drove that population growth again. So the one example I like to really focus in on is Palm Beach, right? So Palm Beach saw significant inflow of wealth, right? So billionaires coming in, right? And if you look at the IRS data, the net wealth movement was most significant in Palm Beach. That only translated to around like 12,000 people moving domestically into Palm Beach. 70,000 plus of the population growth that Palm Beach has had since 2020 has been international migrants, right? So a lot of money moving, yes. Bodies filling up real estate, that's international migrants.
And where are these international migrants coming from?
So
I mean, are these illegal immigrants? Are they well-to-do immigrants?
It's a mix. Okay, so coming out of the Biden era, we had, I think you mentioned earlier, right? It was like 2.5 million net migrants every year. Around half of that would be illegal, right? Typically, we get around 1 million legal migrants, whether it's visas, whatever it is, right? Typically 1 million legal migrants coming in. And they come from all over the place. Typically for Florida, it comes from Latin America, South America, the Caribbean, sub-Europeans. So those are the bodies that really fill up the real estate, and specifically for multifamily. These recent arrivals, anybody that arrived since 2010, their rentership rate is like 70%, right? So only 30% end up becoming homeowners within those first 10 years that they're here. That contrasts to the native population, right? Anybody that was born here or anybody that has been here for more than before 2010, their rentership rate's around 30%, right? So the international migration side of the equation, which is my concern for multifamily, and specifically for the Sun Belt, is that, you know, those bodies that were filling up apartments were coming from international migrants.
So 2.5 million people are coming into the country. Half of those are legal, half are illegal. It seems like illegal immigration has virtually come to a standstill at this point.
I mean, if you look at the border data, which is monthly, since the beginning of the Trump administration, basically zero border crossings.
Yeah. And is the legal migration still at that million?
So that's the concern right now, where the picture that has been painted nationally is not just scaring off the illegal migrants. Part of it is, right, the issues with actual visa holders, issues with people just visiting the country, issues with people that came here and they were going through the legal process. And for example, everybody on TPS, a big concentration of them are Venezuelans living in Doral. They're just getting out. They're leaving because they're very concerned about, you know, a year from now, will I be legal here? And if I'm not, then I don't have a work permit. I don't have a license to drive. What do I do? How do I pay my bills? And even the apartment managers are now checking the legal status of these.
You're Venezuelan, right? You're not leaving us, are you?
I am Venezuelan, but I've been here for like 20 years or so most of my life.
We're going to keep you around, Juan.
Yeah, for now.
He hasn't declared his legality yet.
Yeah. You noticed that, right, guys?
Legality. But it's fine. I know
My
it is.
legality.
Show me your papers.
we want to see your papers, Juan.
I can assure you the CoStar Group does a very thorough review of your legality.
Sure.
Before you join a company. But yeah, there's a lot of individuals on those temporary permits that they were working here, and now they're very concerned about it. So it's not just a mix of lower immigration from the illegal side, maybe some lower immigration from the legal side, but also people that had come in, those 2.5 million, that will likely, a lot of them will be leaving, right? So that is a net negative to our population growth going forward. And you're beginning to see it on the like the early data from like Placer, for example. They've already indicated that all of those Sunbelt markets that were getting all that strong in migration coming out of the pandemic, that's slowed down.
I mean, I was talking to we had a Cafecito Club this morning, and I was talking to a friend of mine who develops multifamily, and he owns a property in San Antonio, and I think he's at 18% vacancy, he said. And he's like, dude, the rents are way down. I mean, obviously that's a huge probably migration.
San Antonio and Austin, though, are completely, I mean, you have to factor in the amount of supply that they pushed into that.
Yeah.
But I will say, I mean, the bigger issue, I was talking to an investment banker the other day that was telling me in the Midwest, they're starting to see in some of the B- and C+ assets, they're starting to see just vacancies rise tremendously.
That's what this was, yeah.
And we're going to see that. We're going to see that in migrant cities like Austin and San Antonio that are adjacent, right? So for sure, Juan's characterization of the impacts on population growth as a result of net in migration declining, that's going to have an impact. It's going to have an impact. It's going to show up in our apartment vacancy rates. It's going to show up in our housing demand. It's going to show up in a lot of different areas in terms of industries that rely on those workers and those.
Well, I mean, if you look at our labor force data, if you trust the labor force data, whatever you might think about it, but it has been flat. Like there hasn't been any growth in the labor force for months.
Right.
Is that AI though too? I mean, that's part of it, no?
No, that's labor force would be people that are out there looking for
eligible
a job.
for work.
Anybody that's actually looking for a job.
We're not talking like job openings. Or
No. So that's kind of getting out of unemployment rates and all of that. It's just people that are coming in looking for a job to a given city or whatever. It's there's no growth.
But couldn't this be a short-term response to the crackdown on the illegal crossings?
So it's a mix
Where
of
else
factors.
are you going to go in the world to work and make money?
It's a mix of factors of participation rates going down, labor force participation rates going down, also the immigration factor, also people that maybe they've been unemployed for a long period of time, just completely exiting the workforce at this point. So the labor market remains healthy, but the cracks are beginning to show up here and there. And once you slow down the in-migration from the labor force side, the issue for real estate is that if labor force doesn't grow anymore, if you don't have employed people coming into your city, getting hired, having a job, being able to pay bills, they don't fill up real estate, right? So typically, and I have a chart, I don't know if I shared it with you guys this time, but typically when the labor force stops growing or ticks negative, overall real estate vacancies tick up and we have a recession.
Are we there yet?
We're not there yet.
Bummer.
We want that repricing. We want activity.
I think of that pic. There's a meme I love, and it's like a stick figure of a person poking a house with a stick, and it's like the millennials trying to get the housing market to crash. Like, come on, crash! Like, God damn it!
It's a weird environment. It's not like maybe we get like moderate downside, not full recession, and maybe the housing market doesn't even budge at this. Well,
like you said, I mean, the housing market isn't going to be as affected if only for the fact that the cohort that we're talking about is 70% renters, right? So,
well, yeah, I mean, that's a piece of it, right? Now the question is the weakness in unemployment going to start spreading out across more industries, across more sectors, right?
Yeah, but I don't know if I could lay that at the feet of immigration policy.
No, not laying it out. No, I'm just saying looking forward with what's happening with general economic trends. Because if you look at the consumer side, most of the spending that's happening right now is being done by the top 10, 20% of households. Everybody else is not driving consumption growth.
Agreed. I mean, honestly, the kids under 30 today are in a terrible job market. I mean, they're in a funk in terms of how to get employed and employed at a level that justifies the cost they spent to get an education. I mean, there's a tremendous overhang of under 30s when you look at the labor force participation rate and the workforce participation, that under 30 group right now is in a much more challenging position. So they're not spending money. They're also not creating new household formations. Layer that in with their other general causes of saying, hey, I'm going to delay marriage. I'm going to delay child rearing. So now you're taking that and stretching that out further. The majority of our consumer spending right now is in the tail end of Gen X and baby boomers. They're spending like mad. And
then if you look at the GDP side of things, like, okay, so consumer spending is not really growing. Well, the one thing that has been growing over the last few quarters is just AI infrastructure spending. Mm-hmm. So anything data center related, it's semiconductor related, like all of that has been growing, but all of that impacts a very specific slice of real estate, and it goes against young people getting jobs.
Yes, that's what I was going to say. I could care less as to the impact on the real estate. What I care more about is it does affect starting job positions, and we're also seeing. I'm seeing it in my business. I get a call a week or two. Somebody wants me to oversee my accounting department. They want me to take my research overseas. Most of the competitors of Integra Realty Resources, most of the major publicly traded competitors, CBRE, Cushman, Newmark, et cetera, they've all taken their research out overseas. They're paying Indian labor $2, $3, $4 an hour, and I can't hire anybody to do quality research for less than 30 or 40 an hour, right? So what's that doing to the economy in terms of giving those people opportunities to grow? And the businesses that are operating in the United States have got to think about the impacts of that, because if we don't start employing these 20-year-olds by the time they're 30, not only are they not going to have any relevant job experience, I don't know how they stay in the labor force in the areas that they're being trained in. I mean, I was with a group of people the other night, and there were 3 kids that had degrees in data analysis and, advanced data analysis and research. And I'm saying, you can't get a job in today's world. And they're like, no.
You know, Felipe, ever since we moved into Büro, my productivity has been through the roof. I mean, I might actually be getting things done for once.
The energy at Büro just makes work fun. Plus, with 8 locations across South Florida, from South Miami all the way to Hollywood, there's no excuse for not finding a spot to get your shit done, Ben.
And we're not alone. Over 500 local companies call Büro home. Everything from creative agencies and real estate firms to tech startups, law firms, and media companies. It's a melting pot of brilliant people, and we don't include ourselves in that category.
We definitely don't include ourselves in that category. Büro really has space for anyone, whether you're flying solo or have a team. There are suites starting at 100 square feet all the way up to 2,000 square feet. They also don't try to lock you into long-term agreements, and everything is month to month.
Let's not forget the important stuff either. The coffee is top tier, staff is incredible, and has a very entrepreneurial vibe. It's not just a workspace, it's a place where work actually gets done.
That's right, Ben. So if you want to level up your workday like we try to do every day, check out Büro. You might even catch us sipping some espressos between podcast sessions.
Or tequila.
Definitely tequila.
Tell Büro the Built World sent you, and you'll get 50% off your first month's membership. See you out there. Cheers.
Later.
If your Instagram is collecting dust, so are your leads.
That's why we started working with Sage Marketing. And I gotta say, they're dialed in, Ben.
Yeah, they'll build out your content, help you with your brand voice, and even create custom reels for you. Stuff that looks good, authentic, and performs.
Whether you just need strategy, someone to train your team, or you're ready to hand it all over, Sage has packages for whatever level you're at.
And the best part, you can book a free 15-minute discovery call. No pressure, just a quick call to see where you're at and how they can help.
Hit up socialmedia.sage on Instagram or check the show notes for the link. If you're serious about growing your brand this year, this is the move. I'll tell you from our end, I mean, we're just, Ben and I are a two-shop brokerage firm, and when we outsource our video editing, our marketing, our graphic design, I never look for anyone in the United States. I look for people in South America, Central America that are in the same hemisphere, same time zone, and I'm paying them $10, $20 an hour tops.
Yeah. So that geo arbitrage is great for profits. It's great for, that's part of one of the things that the stock market is being levered on, right? People are outsourcing that. But it's terrible for our employment market.
Absolutely.
And it's more importantly, it's terrible for our cumulative intellectual capacity of the service workers that live in the United States.
Yep.
So what happens to that in the long run? And I've resisted the trend, and we've done a lot of things to be able to bolster our research support without going overseas. But at some point where every other competitor is doing it, you get to the point where you have to be competitive.
Yep.
But to Juan's main point about the growth in AI investments and the component of GDP that relates to AI investments, the bigger problem is we're investing in taking jobs away from these 2020 and early 30s.
Yeah, and we do have like the semiconductor manufacturing, which will create some jobs here. But I've been talking to universities out in Texas that manage the labor force aspect for some of the companies down there to help them get labor out of these universities. And what they tell me is like a lot of these jobs that the semiconductor manufacturers are looking for, they're just like you're just like out of high school with a certificate program and you start making $40K a year. And okay, this is Texas, it's relatively cheaper, but where are you like living with $40K a year, like comfortably? Like, are you even ever going to think about having a family? And it's like, oh yeah, but in the higher end, you get to 70, 80. And you still got to think about, okay, 70, 80, better, but will I buy a house, have kids, get them to college? Like it's what type of economy are we building for the future? And what I'm seeing is that even with the advanced manufacturing kind of economy that we were thinking of bringing back, the jobs that are being created are not that great. It's not livable wage. And then what eventually this advanced manufacturing generates is excavating from the high level jobs, the high income jobs, like all the consulting shops. All the big consulting shops would hire like fresh grads with, undergrad or MBAs to just start making PowerPoints for them. You don't need that anymore. Why would you go into a consulting shop? For the finance guys, why do I need an analyst anymore? Like this thing just calculates everything for me. Yeah, I got to double check it, but I don't need that many analysts. So there's a lot of segments of the economy that were kind of holding up better, where you could still have a good job, and I see that struggling going forward. And I don't know where we're going to get those high level jobs in the future. I mean, we still have defense manufacturing, aerospace manufacturing, stuff like that. That maybe there's something there. But even when you look at still AI being applied to that, or 3D printing being applied to that, and all these other things, it's like, okay, well, how many jobs are you really going to create out of that? Hopefully a lot. But from the general trends I'm seeing, this is getting tougher and tougher.
Yeah. I think, look, sometimes it's the law of unintended consequences too. Sometimes there will be an event that will happen that will change the perspective. So think about, and let's just take my industry because I could speak directly to it. Think about all the research that my company conducts in-house with confidential client information. And I refuse to allow that to go to India for a reason. And it's not just because I want to support employment in the US. The other thing is it's very difficult to control the confidentiality and security of data once you start passing it, and you can't geofence your systems, and you can't layer in the cybersecurity that's necessary to keep it in-house. But then you take all of the competitors that are out there taking all this confidential information and letting people in different countries have access to that information. So you have some major cyber event where that's exposed, and there'll be a backlash, and people will start to reevaluate that, and then you apply that to law firms and engineering firms and architecture firms and all of the other industries that are service-based industries that are trying to use this overseas labor, and it's going to quickly go, wow, we really didn't think through that all the way. So I think there's probably a couple of events that could happen to turn that back, and then the other reality is, it will affect costs, and that will affect the cost of living. It's not good in the near term for our economy, what we're doing right now.
Do you see something like, service export tariffs happening? Like I could see, I'm getting my subcontractors in Latin America off Upwork. Maybe there's some sort of tariff that's put on Upwork, a 20% tariff if you're hiring someone from outside of the country or whatever it may be.
Never thought I'd be hearing you talking in favor of tariffs over here.
No, those would be super hard to track.
I mean, it's one way to defend our industry here, right?
I like the ideas.
Yeah.
It's, I don't know. I'm not in favor of it just because philosophically I'm not in favor of the variable tax. That's basically variable taxation, right? It's the same thing you do when you lower your corporate tax rate to try to attract industries to come back, and then you increase your corporate tax rate and they fly to lower tax havens. It's the same dislocation that occurs there if you start to say, oh, we're going to put a surcharge on, service work in these various countries. Yeah. That said, it is obviously elevating the quality of life in other areas, which is then going to make those costs are going to continue to rise. Right. So if you're running your whole business model and you think, oh, I just took my $40 an hour labor rate down to $4, and you think, okay, long run, over the next 5 years, I'm planning this out, and I think it's going to go from 4 to 5 to 7. No, you're crazy. It's going to go from 4 to 18 to 29 to 50. Your labor growth rate at that point is going to grow, but you're going to have already changed your cost structure. So, I mean, as a business, you're going to continue to follow those paths, but this is all layered into improved communications, global exchange of information. Like, this is part of being in a world economy. We got to figure it out. We do. We just have to figure it out.
I want to pivot to some real estate asset classes here.
Yeah, let's do it.
Multifamily. What a weird sector that's been this year. And looking at the charts, like I didn't realize 33% of the new construction is downtown Miami in South Florida.
Yeah, so still, urban core luxury is still a lot of the construction activity, and
rents are flat, concessions are up.
Yeah, in most of the Sunbelt markets, that's still the case, and the expectation is that by now it's been like 2-3 years of flat rents, and that at this point, incomes will begin to catch up, right? And that'll help to, feed some rent growth into 2026.
You're not selling me. I'm not buying it.
Because there's so many factors at play. Because we were getting to that point where the income was catching up with the rents, and we still had population growth and household formation. That was all in play. And then kind of things switched gears where the only thing left driving rent growth going forward is kind of income growth outpacing rent gains again. While if you look at expected population growth and household formation, it lags all the supply growth that we have seen, right? So you still have a lot of luxury multifamily supply that is targeting the same types of renters, and there's not that many of them, and there's that pool of renters isn't growing that much anymore. So there's still, the renters are sticky because home ownership is trickier, or maybe impossible for some people. But the fact that home ownership is hard has kept some renters in place. That's helped absorption, but still the supply overhang has been there, and it's still so significant that for all of these players to grab renters, they still have to offer concessions and keep rents flat, right? So the hope is that income growth will help into 2026. The question is what happens with the population growth side of the equation, and whether or not that'll help here. Because if we had this population growth squeezing people into class A, B, and C apartments all at once, then yes, sure, you're going to get rent growth. But right now, because B and C apartments are not getting filled up with people, in fact, those vacancy rates are starting to tick up, they're going to have to offer rents at a discount to keep renters in place, which then keeps renters from going up the ladder into a 4 and 5 star. That drags on rents for 4 and 5 star, right? So everything's interconnected here, and it's not a super complicated picture here. It's just like we just need household growth and population growth and employment growth, and we're not there right now. I'm not saying we're never going to get it. We will get it 100%. The fact is that we had already been coming out of a slowing economy, and the trends that we're seeing over the last few quarters have not fed a resurgence in the economy, except from certain sectors like the AI sector.
Do you feel like we're bottoming out? You have this great chart. It shows South Florida multifamily construction activity defies national trends. I see the national trend line for the U.S. is below the 2015-2019 average for construction activity, whereas Miami, Fort Lauderdale, Palm Beach are all above that average.
Yeah. So
and it looks like it's not ticking up quite yet, but it's flat. And just knowing, being active in the market, I know a lot of guys not a lot of starts are happening on multifamily. Just deals aren't penciling. So is that going to help absorb what's existing and start the rebound?
So that at a national level, I can tell you yes. And we're already seeing the supply picture already like have an effect in Midwest, in the Northeast, where we're seeing healthier rent growth. The Sun Belt is challenged because we were getting all the supply with the expectation that in-migration and population growth were going to remain strong. And right now we're taking a breather on that, right? So the supply overhang that we're getting from what was in the pipeline it's much like industrial. It's like we're getting a supply overhang that's going to last a little while. Despite that, like if you look at the data for South Florida, construction starts, they're not going down as significantly as they were for the national average. So we might have a little bit of an extra supply overhang here in South Florida because multifamily is the only asset where we've been building a ton. Because single family, we're building it in the outskirts. Like if you want to commute over an hour and have a new home, okay, good for you. But most of the housing close to the urban core is going to be apartments, right? So the piece that developers are expecting from that is that we're going to continue to become a renter city. And that has been the trend over the last few decades, where our homeownership rate continues to trend down. And just given the fact that unless you look at condos, like if you look at single family home pricing, I mean, there hasn't been such a significant adjustment right now to make it, a free for all.
No, I don't think we've seen any major declines in the single family homes. Certainly,
Right.
We're starting to see that a little bit over 1 million because the buyers have selectivity and they have opportunities to negotiate. But in the under 1 million segment in Miami-Dade County, we're not seeing.
Doesn't exist.
Well, I mean,
if you want a nice one, then you don't
Dude,
have
$1
to
million
put
bucks
another.
within a mile of my house is a shit box. Like, it's pathetic.
Exactly. You have to put another million into it.
well,
Yeah,
and
actually.
therefore that is the reason that we're not seeing those price declines because
Right.
it's very difficult to find something for 400, 500, 600,000. But then when you look at what that translates to, if you buy a $600,000 home, what would your overhead be per month? Like renting looks cheap, right? I mean, we've been having conversations about affordability in South Florida for, I feel like, a decade already. What's the affordability solution? The answer is more supply. But the problem is the existing supply is then going to come down in price. So it's like, be careful what you wish for, right?
Right, because
if we want values to be held up and we want rents to grow at some normalized rate of 3, 4, in a rate in excess of inflation, then our housing is going to continue to get more expensive. So it's like, if you want to have a conversation about housing affordability, then you have to say we need more housing and we need rents to come down, which is counterintuitive to what we want as landlords, as owners of multifamily, what we actually want to happen as investors. At the same time, I haven't looked at the housing start data. I'm surprised when you tell me that the housing start data is higher than trend.
It's for multifamily.
For multifamily, but I have to put that at the feet of Live Local only because I'm not talking to any private developers that aren't receiving some type of incentive, tax abatement or otherwise that can make the numbers work.
Yeah, so
Unless they're
we've
building a high-end
we've
condo.
seen the share of under construction by star rating continually tick down, meaning that under construction by star rating of 4 and 5 star, right? So
What that's a CoStar classification. So you're saying that
so
the Class A
apartments
highly
highly
amenitized
are becoming a lower share of the construction pipeline. So
Correct.
that would feed into the idea that more live local apartments are getting are being put underway, and we need that 100% because I mean we had this supply wave of luxury with the expectation that high income renters are coming in, they're going to fill these up. And the reality of it is that even though we still have a very pricey home ownership market, the household growth hasn't been there, the income growth hasn't been there to justify the 4 and 5 star luxury apartments that we're building. And therefore you're getting concessions and flat rents over the last 3 years for those that segment of the market, right? So the disconnect between our renter pool and what we've been building is very significant. Only around 10-20% of our renters can afford the buildings, the apartment rentals that we've been building. So, and a lot of the units have been getting filled up because, people are coupling up and they're able to afford those rents. So I think Live Local is a necessity to shift our supply wave into a more of an affordable component. But even within that affordable live local component, you're still only tackling maybe the next 10% of the renter pool. The affordability issue is way bigger than that, and there's things that we just, as a market economy, we're just not going to be able to tackle that easily, to be able to give housing to everybody at a fair price. It's just not there when our geography, our building costs, our labor costs.
That's what I was going to say. The cost to build is so high here
Exactly.
with
So you
CBS
can't-
and
you can't-
hurricanes.
exactly.
It's just,
Yeah.
I talked to friends in Minnesota who are building stick, and the yield on cost they're getting is laughable. One guy told me 11. I was like, I was like, you're lying 100%. But it happens up there. They're getting high rents and they build stick. It costs nothing to build, and there's land forever. Here we have limited land. We have to build CBS. Impact windows and all the above makes it really tough to make deals make sense.
Don't forget the old maxim that insane margins breed ruinous competition. Right? So everybody's going to run to Minneapolis now.
I'm not going to
on the heels of this podcast. Everybody's running to
Good
Minneapolis.
luck. Enjoy January. Yeah.
But we are seeing that in certainly in the Northeast, right? We didn't see as much being built in the Northeast during the run up. We didn't see the same type of supply overhang. And so as a result, Northeast and the Midwest rents are actually holding up pretty well. But the biggest challenge today is, the folks that really had counted on that 3% money to continue to roll, doing interest only. And now all of a sudden they're trying to amortize and they're, so we're going to start to see trades at numbers that, not only going to be below replacement costs, they're
Dude,
really
it's already
gonna
happening.
Be, yeah.
There's already distress. The same friend I was saying that I talked to this morning said he bought a deal. I don't remember. I think Texas or Oklahoma, maybe. He said these guys paid $30 million for this asset in 2022. We're expecting to, capital improve it, raise rents, do all these things, and the refi came up, and none of the above materialized. He just bought it for $15 million. So there's already distress out there, like that's happening.
No
right
question.
Now. Yeah,
no question.
Let's move on to retail. Retail seems fine. Next.
Fine.
Right? Retail seems like it's pretty good. I'm based on your charts. Like, what's going on in the retail world?
I mean, so like the rest of the country, right? We haven't built retail in decades because of the fear of e-commerce. So it's being held up by the fact that we have an undersupply of retail, but that's also asset specific, right? So grocery anchored retail, necessity based retail,
strip centers are a huge thing right now,
those same trends that we've been talking about for a while, that holds up, right? Because that's where you have your grocery store, your barber shop, maybe your dentist, whatever it is, it's there, and you can't really replicate that, because, and more so in a market like South Florida where land is so expensive that you're not really going to build a strip center with a bunch of parking. In a neighborhood that's expensive, right? Like where, for example, like Weston or Parkland, where do you have land left to build a retail strip center? It's non-existent. So the retail that we have been seeing is like Brickell City Center, like these mixed use developments that are huge, right? And the trend expected going forward, and this was being talked about years ago already, was more mixed use, right? You're going to play multifamily, office, retail all together into these new little neighborhoods that you're going to be creating. So the expectation is that mixed use is going to be kind of the next cycle for retail. But if you're able to buy a retail strip center with a grocery anchor and with a Publix on it, well, good for you, man. Like, share that listing. But yeah, retail is expected to hold up. Now, there are concerns around some of the like new retail areas with a lot of like restaurant exposure and stuff like that. We'll see how that shakes out, just given the fact that the consumers are the bulk of the consumers, not the high income consumers, but the bulk of the consumers have been pulling back on spending, and their grocery bills and other bills have come up significantly. So I can't just go to a restaurant every weekend, right? So if you're not in that like high income neighborhood, your retail might struggle a little bit more, and there might be some more tenant churn. But overall, the tenant demand has been there to backfill space because there isn't space available, right? So
there is downtown Miami, according to this chart.
There is in downtown, yeah. But that downtown Miami slice, there's like one asset there that's like driving all that availability. It's really old, really tired. It needs to get like basically torn down.
You're talking about most of downtown Miami.
This is like north of the bridge.
Yeah.
And that area, it needs a lot of more.
Brickell's not part of downtown.
No, and it needs way more density so that the population, the household population increases. That area should be the next for development. We'll see if that happens in the next.
You asked about what do we do with industrial real estate? How do we convince owners to sell? How do we get in the game? I'm seeing this happen more and more when we look at these aggregate statistics. We're doing a study right now on what the vacancy rate is in a particular neighborhood in multifamily. And when we dug into the study, you can get online, you can type in a zip code, and it'll tell you what the vacancy rate is. You can go to CoStar, it'll tell you what the vacancy rate is, and the numbers were like 6, 8, 9, 12%. And the client's saying it's lower than that, So we went in and we did a peering study, and we identified the market area, identified specific buildings, and then we started to pull those buildings out and say, wait a minute, that building is slated for demolition, but it's still in the denominator of vacancy. Oh, that building has been vacant for 5 years, and we know that the owner's not putting any money into that building. That's in the denominator. And so when we dug behind the gross statistic, we're so excited about all this aggregated data, when the reality of it is a lot of it's not good on the ground. In retail, I think it's the same. We're seeing a lot of the same things in retail in terms of the aggregated data. We talk about retail vacancy. There's no such thing as retail, right? I mean, the reality is you've got malls, You've got mixed urban centers. But part of the vacancy rate in downtown is all of the mandated retail that every apartment has to carry on the street. And all of a sudden you've got this building, and it doesn't look like a lot of retail, but when you wrap a building that's got 400 units, you got 30, 40, 50,000 square feet of retail. And what are you putting in it? A beer garden, a nail salon, and then the rest of it's vacant. So then you look at the retail vacancy rate in downtown Miami, and it looks huge, but it's really because most of these retail that's wrapped around an apartment is 50% vacant.
So in our data, that won't affect the vacancy rates, because if you have a mixed project where the ground floor is going to be retail and then you have multifamily on top, like that'll just get aggregated into multifamily analytics. We basically ignore that retail for now until we build out the European product, which we will need that built out. But that's not being aggregated. The issue with the downtown stuff is it's like one big retail asset that has been struggling for a while. But generally that issue that you were mentioning where like you have, yes, we need retail, but it doesn't mean you build a multifamily property, put retail in the bottom, and then that retail is going to outperform significantly, and you're going to get at least up in 2 seconds. The retail needs to be really well thought out, right? Like you need to think about the walkability, the foot traffic, the parking, what types of the tenant roster that you're going to have there to attract that foot traffic. It's not easy, and it's not like just sticking a retail into a component of housing is going to do it for you. Like that, it doesn't work like that. Like why would I, if I think about going to that, the reason why grocery anchored centers are performing the way they are is because they already have foot traffic built into them naturally. I go to the grocery store a couple times a month, and then from there I will go to the barber shop, to the other shop down there, to that one over there, because walking distance is right next to where I'm already at. I don't want to deal with more traffic to then cross the street and then find parking again and then go to that other shop, which is on the other side. Like that makes no sense. And that's unfortunately how South Florida and many of the cities in America are built, that you have to get in your car to go to the next strip center over. If you look at some of our centers, you sometimes, like I leave the parking lot, I'm like, oh, okay, well, I'll just go to that one over there and just cross this parking lot. And no, I can't just cross the parking lot and get to the next one over. I got to go back to the main street and then go back out, because that owner over there doesn't talk to this owner. So they don't want to create an easement or connect the two centers. And that lack of connectivity is what hurts us here in terms of that retail walkability, retail connection, creating aggregation of foot traffic, and that's happening with the multifamily.
Yeah, my point about the statistics is when you look at retail, we tend to think about retail as an asset class. But it's very often that I hear people say, oh, the retail vacancy in such and such market is 14%. And then I find that 9 points of that is in the mid-box 30 to 50,000 square foot vacated boxes that there are no tenants. I mean, if you don't have a Petco and you don't have a Dick's, then
like the department stores, the department stores that no longer,
the old Kmart's and the centers that are C minus. And so then you find 3 or 4 centers that are in that vacancy rate that are 80% vacant, and everything else is really 6 or 7. So I guess my point in that is to say retail is in a pretty good spot in terms of where it's trading on replacement costs, where rents are. I do think in the next 24 months, there are some risks because consumer spending is in jeopardy. As Juan pointed out, a lot of these centers are tenanted with restaurants that are not going to have good holding pattern through a decline in consumer spending over the next 24 months. But that said, the retail repricing that occurred in retail through COVID and all of the repositioning of those assets, and the fact that we haven't built a lot more, we've historically been over retailed, but we've been demolishing a lot of the big stuff, right? The malls are coming down in favor of mixed use and repurposing of those malls. So your square footage footprint per capita has definitely been going down in most markets, which is going to benefit the value of retail. And then just changing consumer patterns are important. I would say, though, everybody focuses on grocery anchored retail. I think in this environment for the next 24 months, a focus on what I'll call retail value plays. You want to buy those centers that have a Marshalls, a Home Goods. You're staying away from Home Depot and Lowe's because people are going to spend less improving their homes in a downside economy, but they're going to be looking for value. So any value retailer is going to be a good opportunity for the next 24 months. Groceries are getting expensive. And I would also say what the retailers are coming to grips with is Juan and I don't matter how men travel to shop means zero, right? I get up on a Saturday morning, I go to Home Depot. I'm not going to all of a sudden say, oh my God, I got to go across the street and get this other thing. Like if I'm going to Home Depot, I go to Home Depot and I go home. That's not how my wife shops, right? She goes somewhere and then she's like, oh, and I got to go do this other thing. And then I got to do this other thing. And she'll plan out a whole route. And by the way, I'm going to go hunting, at Marshall's to see if I could find and she'll go in and sort of just shop. Women's spending patterns and their travel patterns now are a lot more important than men's. That's just the reality. And I think the retailers are really honing in on that. But consumer spending is going to be the challenge over the next 24 months. As the economy holds up, great. If we grow 1.5 to 1.7 and the employment market holds up, terrific. We've got a little bit of room, right? We're not at a 7% unemployment rate, but it's starting to crack and we just got to keep an eye on it.
By the way, my wife's the same way. Imagine just going to hang out in like Ross with like this shitty music playing, the worst lighting. It literally gives me a headache. I can't imagine the least desirable place to chill. I'm in and I'm out. Like
my wife says the same thing about Home Depot, and yet I can spend hours. I can spend hours in there analyzing the different types of screws I need.
Touche. All right, office. Florida continues to attract companies leading the nation in firm migration, but it looks like we're below pre-pandemic leasing activity. What's going on with office these days?
Yeah, so the net firm
not
migration...
so buzzy anymore, huh?
Yeah, I mean, the net firm migration was obviously skyrocketing coming out of the pandemic into Florida. And historically, Florida tends to get much stronger net firm migration than the next 10 states on average and most other states, right? So we attract companies. But, the surge from the pandemic period was bound to slow down. And that's what we're beginning to see, right? And we don't have an updated net firm migration data that comes from, I think, the BLS. So whenever the government decides to open up again, maybe we'll get more data. But the data we do have, which is the CoStar data, because we don't stop working, that leasing activity is showing a downtick in terms of the amount of leasing transactions that have been happening. So I think the healthiest one is probably Palm Beach. But for Miami, it has ticked down over the last year or so. And that's a factor of, the slowdown of net firm immigration, and also the office using employment has not been growing that much over the last year or two. So if you don't have office using employment growth, then you don't need to put employees anywhere. So why lease space? And you also have kind of tenants shopping around. Our rental rates skyrocketed in certain areas. So, for example, Brickell, rental rates skyrocketed significantly. Any nice looking tower east of I-95 saw significant rent growth. And tenants are rethinking whether or not that makes sense. And if I get half the rents moving to Coral Gables, or maybe I'm not in the middle of downtown Fort Lauderdale, I just move from Las Olas a block down and I get half the rent. But some new owners have come in and they've revamped some of those staler, still Class A office product, but they've revamped it, made it look nice, and the rents are half of what you're getting charged in that trophy tower, and you're just like, okay, then why wouldn't I move?
But they're not moving. The reality is that the vacancies in the high value towers are way better than those mid-B buildings. I mean, look at Dadeland. Dadeland's a perfect example. When rents downtown were $50 and $60 a square foot, or even $45. I mean, I remember when what's the building on 14th in Brickell? 1450 Brickell.
Yep.
They were so excited. They hit a new high watermark for office leasing at $45 a square foot. Now, this is in 2013, 14, but at the time that was a brand new building and they were excited. They got to 45 a foot. But at that point, Dadeland was at $25 to $30 a foot. And the brand new office building in the southern end of Brickell is trading at 40, or leasing at 45. All of a sudden, that 1450 started to set the mark. It became 55, and then 60, and then 65. And then we had the building at the Brightline station that leased up, and that was leasing up at 65. And then we have now Citadel's building, and they're talking about leasing rates north of 100. Everybody's excited because they're at 100, 125. Go down to Dadeland. You could still rent space for $40 a foot. And there's been no new buildings built, and the vacancy rate's 10, 12%. So we're not seeing the because the tenants that the big buildings are attracting, these quality buildings, they need to be in the best building in the market. These are your Microsofts, these are your Ernst & Youngs, these are your major, they want a headquarters location in Miami. They're coming to Miami and they have to be in the best building in the market. They're not cost shopping. The difficulty is going to be what's happening with the downsizing of law firms, right? The law firms used to be a very, very big, heavy presence. And are they going to stay as large in their per person footprint? And then the other question is, can we continue to attract tenants that are paying those types of rents? Can we continue to find it? And what I would say is, I feel like in a lot of ways, this is like in retail leasing in malls, right? You look at the rents and you say, okay, here's the market rent. The jeweler never cared what the market rent was. The jeweler could always pay 3 times as much because they were selling this tiny little diamond for $9,000, right? I think some of the leasing benchmarks that we're hitting here, where we're very excited about, oh, we broke $100 on this lease, are being leased to tenants where the office cost is irrelevant to them. They're so profitable per person. Their revenue per person is so high that it really doesn't matter if they pay 50 or 60 or 100. What matters is that they're in the nicest building in the market, right? And so they're attracting tenants that way. I'm also going to take a contrarian view and say, people are coming back to work. We're starting to see a lot more companies getting back to 3, 4, and 5 days a week mandatory. And I said that wasn't going to happen until the unemployment rate hit 5.5%. We're certainly not there yet, but we're starting to see employers require people to come back to work. And I think part of that is that's going to drive the office market. Now, that said, Miami's probably one of the top 5 office markets in the US in terms of pricing, value, rents, demand. But at the same time, you can go to suburban Chicago right now and you can buy a suburban office building completely vacant for $30 a foot.
Yeah, but who wants to live in Chicago?
Well, that's not the point. But the point is in terms of value plays, what we are starting to see is in a lot of these markets, the suburban office buildings are almost unbeatable. Like they're almost at land value at this point.
So I think, the trends that you were hitting on, which is those big players, leasing the downtown towers.
830 Brickell. By the way, $195 a foot.
Yeah, $195 was the latest. And that was 18,000 square feet. But anyways, Microsoft leased that space and it got gobbled up. That was like 2 years ago, like a year or two ago, right? Like what has happened since is that a lot of the other players that were seeing this happen and they had nice towers, they started to bring their rents up as well, seeing that, oh, there isn't that much space available in the market. Now I can compete at these rents. And when some of the tenants come up for renewal, and not all of these tenants are Microsoft, a lot of these are local players that they will look at that rent and say, what? Like that eats into my bottom line. So we have seen, and for example, it happened at first in Palm Beach, because the Palm Beach rents were going crazy in downtown in the brand new boutique office.
Well, it helps when you have one owner of 90% of the office market in one location.
So in Palm Beach, it happened like a year ago where the leasing activity slowed down in downtown, and then it started ticking up significantly in the northern quadrant of outside of downtown, because there were still, relatively attractive office buildings there where the rents were much cheaper. So you had some of those local tenants get pushed out from that market. And we're seeing that we saw that happen a little bit in Miami, tenants moving out of Brickell into Coral Gables, into Waterford. And then we're seeing that in the Fort Lauderdale game right now, where it's more concentrated in downtown, but also tenants begin to look for the good deals. It doesn't mean that Class B, Class C office is gonna get leased. What I'm talking about is the next level down from real trophy, which is still nice and it's been updated. It might not be in the perfect location, but it's your next level down. So we're seeing some activity there because the rental rates on the best stuff are incredibly high.
I agree, but I'm also going to counter that to say that if you're bitching about your rents going from $45 to $55 and you're saying to the landlord, look, I got to move. That's ridiculous. $10 increase. That's ridiculous. Then you go out shopping of your alternatives. And even if you go out shopping in a slightly lesser building, when you go to get your TI costs, that $10 a square foot goes away. But your TI cost, your amortization of TI is so high. They're not
$10 increases. They're like in summer, like in Fort Lauderdale, 35 was the prior healthy level, and then they pushed it up to $75 a square foot, so it's more than double. The rental rates in Brickell were like in the 60s, and now we're talking about 180, 190.
Yeah.
So they're not $10. I mean, there's significant increases, and I think that some of the landlords, the new landlords that have come in, they are more willing to attract tenants into their, next level down at those attractive rents, give them some concessions on TIs, et cetera, and help them build out that space just to fill up. So we are like, it was bound to happen. Like the office market just peaked so high in South Florida that we're not falling off a cliff, because we don't have any available trophy space, right? But now it's the time for the next level down to get some of those tailwinds. If you look at the rent growth, anything built since 2010 saw all of the rent growth in South Florida. Anything built before 2010, similar rent growth trajectory, didn't really spike significantly coming out of the pandemic. So I think there will be a little bit of a churn over the next couple of years of, some of those local tenants looking for the better deals. And hopefully what that unlocks is eventual space availability in the trophy towers that gets backfilled by these players that can actually pay those rental rates, and that brings some high income jobs to the area, et cetera, et cetera, et cetera. We are in the early stages of that, so maybe we'll get that, and we'll need obviously an economy in a general national economy in a different shape, interest rates at different levels. So all of that needs to get put in place at the right time for this next stage of the domino effect to take hold. But for now, what I'm seeing is that leasing activity slowed down. Rental rate growth has slowed down significantly. We're still the healthiest market, as you mentioned, like one of the healthiest markets in the entire country. Don't get me wrong, but I think the play for the trophy tower, for get the best tower and run up the rates, that is maybe a year gone now. And we're into the next phase of that of, okay, what's the next level down? Those towers that are close to that trophy asset, maybe put some capital improvement into it and get the tenants that will offload from the trophy assets.
I was so excited when we decided to go head to head in the first quarter with me and Juan, right? And then I realized at the end we didn't really go head to head. So in the second quarter, I was like, that's it. I'm going to challenge this guy. And then I thought like, oh, this was so fire. But realistically, actually, we mostly say the same thing, just from two different microphones with like a slight little modification. I agree with everything, and I'll add one other thing. If you're investing in Miami real estate generally, or in office real estate in Miami, beware of what I call the Lincoln Road trade, right? So Lincoln Road had a run up where rents went from 40 to 50 a foot. All of a sudden they're at 100, then they're at 300, and then all of a sudden Terranova and others go and they sell all their assets at 3,500 to 4,000 a foot, and the taxes went bananas. So you were a tenant that was paying $60 a foot in rent, and your taxes were $12 pass through. So you were at $72 occupancy cost. All of a sudden rents go crazy, but you're doing well. So you agree to $150 rent. Then your landlord sells the building for $3,500 a foot. Your $12 taxes all of a sudden go to another $80, right? So the other element of the strength in the office
it's a ghost
market
town now on the West End.
Well, and so that the other element of what happens in the strength of the market, because of the way our ad valorem tax works, is that, when these buildings are trading now at $500 and $600 a foot, they're going to start to get assessed at $500, $600 a foot, where before they were assessed at $300. So now your tax pass-throughs going, crazy as well. So there's the face rent, there's the concessions you get on the TI that you're amortizing over a 10-year period or whatever. But then there's what are your pass-throughs and how can that change, and controllable costs that you have to manage. And all of that's going to conspire, I think, to Juan's point, to slow our office market. But the good news is when you're at, it's like we're slowing something that's at a very good, healthy rate right now. And I there's probably 3 or 4 planned million square footers in office buildings downtown. And everybody keeps saying like, how are we going to absorb that much? And I'm like, we're never going to have to. Like, that's not getting built right away. It's going to be a longer phase in and lease up of our office.
Yeah, I mean,
space.
we got a bunch of cancellations on office towers that were planned in downtown Brickell last year or earlier this year.
At the beginning of this year.
But yeah, I mean, the developers will put their foot on the brake when things don't make sense, and more so for office because it's getting all the eyeballs right now. If you don't get it right, you're not going to get financing. You're not going to get anything for it. Yeah, I don't see like an oversupply problem. Maybe on the suburban 1980s vintage, really outdated stuff that there's just no fixing it. Like there's no debt's going to help you. It's going to be tough to lease it up. And what I've heard is that, some of those could likely get developed eventually in the next coming cycle into industrial, which we saw with like the Ryder headquarters and stuff like that, because they're really well located close to the highway. They're just like right there on the outskirts of South Florida, and it's a lot of land, and they're still close to suburban areas where you still gotta, serve customers. So you got some redevelopment plays there. So I don't see, and we haven't seen like a significant surge in distress from the office side.
Miami.
In Miami.
Yeah.
A few things. Well, there's 100% some out there in some of the California markets, Midwest, et cetera, where they've traded at significant discounts. But in Miami, we've seen a couple here and there, but nothing major. And, you still got this redevelopment play that you can do for any of the existing assets. And the fact that our land values have increased so much, I think maybe the land will save you on that.
I mean, there's a lot of through lines with all these asset classes, right? I mean, we've seen kind of a sobering effect from what was all happening post-pandemic throughout, leasing seems to kind of be down. Everything's kind of slowing down. Nothing's really crashing, but we're kind of plateauing across the board. Interest rates are sobering things up. Migration's slowing down, so that's sobering things up. And then on the flip side, we have all-time high gold, all-time high stocks, all-time high, everything, credit card debt, everything's kind of shooting through the roof. What do you guys think? Is there going forward, what's your outlook? Any predictions for Q4 that we're going to hold you to on the next pod?
Well, I mean, you haven't held me to my second quarter prediction even. I said we were going to rip, and we had a third quarter that was a little bit tepid, right?
Yeah.
But again, I think that you're talking about correlation, which is important, right? Do the asset classes, are they disconnected or are they correlated? And the answer is they're correlated, because capital markets are correlated and the investment pools are correlated. Like what you're talking about in terms of asset growth is about where is the money moving?
Right.
And as that money moves, it moves in and out of these asset classes. How fungible is it to go from one asset class to another? And the answer is we have a pretty sophisticated economy that moves the money quickly, and it gets to the point of best efficiency quickly.
And right now, it's all percolating to the luxury sector. That's kind of the only thing that's really popping right now.
I think in the real estate side, you're
Right,
saying, yeah,
right.
I think that's largely true. But also, if you look at the stock market and you look at publicly traded companies, that's also, people are migrating to these areas of highest yield, highest value add.
Yeah, because who's pulling the most? It's just like NVIDIA. It's like,
Yeah, like if you look at the all-time highs in the stock market, it's like not everyone.
No.
It's like 7 stocks and that's it.
Yeah.
Like, okay. So if you're invested in those, if you're the 10 households that are invested
or
in
in an
those,
index,
good for you.
or in an index. Yeah, that's being propped up by all that.
And that goes back to the, the gold, the stock market going to all-time highs. That helps the 20% of households that are on that bracket that can invest in those assets. Everybody else is not doing that great right now. They're kind of struggling, and that's why we're seeing the consumer side kind of weaken a little bit from that 80% of households that just can't. They're pressured by the inflation story that we thought was going to go completely away and is still haunting us, and they're pressured by the fact that the labor market is becoming more challenging. It's the unemployment rate's not terrible, but it's becoming harder to find a job, and a good paying job, it's taking longer. And
the unemployment rate metric has been modified in terms of participation in the labor force and how we're counting that, so much so that I'm not even sure that it's an accurate representation. And we continue to mask government employment versus private sector employment. I've maintained that we've been in a private sector employment recession for the better part of 18 months in terms of private sector
if you look at
growth.
office using employment growth itself, which would be a metric of excluding government and anything like that, and it's just
You
a
take out
metric
government,
of
you
high
take out
income
seasonal
employment,
jobs, you take out retail
where
jobs.
we've been
We're-
flat for over a year. Yeah.
And so then the problem with that is then you turn around and you say, okay, so now as a government, we're shut down and we're going to start cutting government payrolls and we have to lower taxes. Well, then that's going to really start to eat into the security. So I think all of these things point to, things are going to go a bit slower. I think the bigger thing that investors are asking today is, are any of these asset bubbles ready to pop? Are we going to see a big stock market correction? Are we going to see, a big real estate value correction,
AI
both
bubble.
residential? What's that?
The AI bubble.
Yeah. Is there an AI bubble looming out there similar to what we saw in the tech world, in 2001? And what does that do in terms of, expectations? And I even the people that are in this technology sector that are talking about productivity gains and AI and all that, we need it because as Juan mentioned before, in terms of population growth and in-migration, we need to continue our productivity growth. And I was having a conversation with a business the other day that's in the tech space. And I said, if AI had not appeared, if the LLM had not appeared in 2013, end of 2013, and showed us what was possible in this area of reading documents and aggregating, where were our productivity gains coming from? There's no new Excel. There's no new Microsoft products. There's no new internet. Like if AI has not progressed where it was, we were going to grow in the back of TikTok. I don't know about that. So I think that all of this is good, but I do think a ton of money is trading right now on this technology, productivity. We're going to invest in this and be the first movers and be the fastest to act because we want to dominate this. And in my experience, nobody ever dominates, right? I remember when we used to talk about Microsoft being a monopoly, and I think that's a misnomer. So I would caution to say this is a difficult time in the market, but at the same time, for those that are worried about there being an asset bubble in commercial real estate, the flip side of that is there's a limited amount of land. And construction costs have risen so much over the last 24 to 36 months that we kind of we can't benchmark this based on what were real estate values 10 years ago. And is this an asset bubble? It really needs to be, what's the replacement cost of real estate today? And if you do that, it doesn't look as bubbly.
Graz, do you think that construction costs are going to continue to rise, particularly on the labor side, with migration not happening, and then just on the natural resources side as well? What's your take on both of those?
So I think the current thinking is that the tariffs have impacted construction costs to the extent, steel, concrete, and so forth are up, but labor costs are down currently. Obviously, as the supply pipeline, as people as the developers choose not to move forward with projects, then we're going to have excess capacity on the construction side, which will make them more competitive, which will lend us to have a fundamental decline in construction costs, or at least a softening in those increases. I mean,
We're already kind of getting there.
yeah, we haven't seen the increases over the last year and a half or 2 years as things slowed. And now we're going to start to see the contractors get competitive, and they're going to start to be more
It's
competitive
happening
in
right
their
now.
bidding.
Yeah. I'm seeing it on the ground.
Yeah, which leads me to believe that construction costs will moderate. But overall,
Materials you think are gonna decline, and labor is also gonna decline?
I think what's going to happen is the material cost increases are going to slow. So you're not going to see as big of an increase in the materials cost. I don't know how you can argue for a decline in that given the cost of transport and some of the other.
No, I mean,
the
if you look
input costs
if you
are
look at
tough.
like the new warehouse construction index, like which tracks the inputs into like a new warehouse construction, like the increase dramatically coming out of the pandemic. They've been flat for a couple quarters now, ticked up a little bit in the last month, but not a significant movement up.
But there's not a big concrete component to that, and there's not a big steel component to that.
Right. So there are segments where you will have these material cost impact, but maybe some of that will get helped out with the lack of development that's happening. That will help on the construction labor side. But then at the same time, if your construction labor is leaving the country and not coming into the country as much as it was, then you get some tempering from that as well. But the real question is like, what do you build? Because where we're seeing the weakness in the real estate markets is where we overbuilt, and that's industrial and multifamily. Retail is really complicated to build, And an office as well is really complicated to build. Like if you look at new office towers that are getting developed, they're getting increasing delays over the last few years. And part of it, developers don't really want to, pull the trigger on brand new office developments with what's happening with, office using employment growth, with AI, et cetera. Is there demand for it? If you look at household growth, is there demand for new multifamily? It's questionable. The only one where you could build more is kind of retail right now, but again, it's really hard to build. So, and then the consumer outlook is not great either. So even if construction costs are moderating and labor costs may come slightly down, that doesn't mean we'll get a flurry of construction activity.
Agreed. No, I think I was addressing the point that while the assets look like they're overvalued, when you compare that to construction costs, they're not unreasonable. And I think Felipe was saying, yeah, but are construction costs going to come down? I.e., isn't that spread going to widen? And I think the answer probably is yes. But I mean, again, it's all about timing and basis. I don't think that we've fully baked in the renewed value of these construction costs long term. I think in the short term, yes, they're going to moderate. But in the long term, they're not going. You're not going back to building an industrial building for $60 or $50 a square foot.
Well, I appreciate you guys joining us. I feel like this is a really weird real estate market, so it's time to bust out the popcorn and wait and see what happens.
I'm still pretty bullish on the fourth quarter since you asked.
Yeah,
I do. I want to see
love the
this
optimism.
Yeah.
I want to see this economy grab on.
So what drives your bullishness for the fourth quarter?
I really think that, again, when we look at where the capital flows are going to go, I think the United States is in a really strong position to continue to attract capital.
Well, that's like the one thing, sorry to interrupt, but that's
right.
the one thing that I keep coming back to. As bleak as things may look, or boring or flat, it's just like, where else do you go? Like, where else in the world where else is investable? Like, I'm not putting my own personal money in China, in Brazil, in Europe, in UK. Everywhere else is kind of fucked. So it's kind of, the US is the only investable market in the world, in my opinion.
Yeah, and that's going to show up, especially if we can, if the dollar continues to decline against world currencies, that's going to whip people around to come back to security, right? And we are the most secure place in the world to invest. And at the end of the day, when the economy gets bad, hard assets attract capital, right? Gold is attracting capital. Real estate's a hard asset. It's not going to zero. So if you start to look at the magnitude of what's in the bond market, in the equities market, and so forth, I think that the opportunities are the problem. The problem is people don't see the opportunities right now. But when you start seeing $50 square foot buildings trading in downtown Philadelphia for office trades in downtown Philadelphia, that money's coming.
No, and to that point, like we've seen our latest transaction data at the national level has seen a significant spike in activity. So maybe not so much for South Florida, but volume has ticked up at the national level for all real estate. And it's not just like big portfolio trades. Like,
see, here I thought I had a contrarian opinion, and now he's agreed with me. This is exactly what I'm talking about.
So activity is there. Now, for real estate coming back, but for the general economy, I don't know the Q4 time period, and maybe more so because now I'm covering only industrial, and the industrial sector, like all the trends I see are like I want to be positive. I swear I want to be positive. It's just all the indicators I see are like there's no growth. I want growth. And the small bay assets are okay, but the large box logistics stuff, man, oh man.
I'm a classic contrarian. So I went to Commercial Industrial Association of South Florida, CIASF. They asked me to speak at one of their conferences here in South Florida. This was maybe early 2023. And I go in with the perspective that, here's what's happening around the country, and here's what we're seeing coming off of 22, interest rates are increasing. Here's the forecast for the economy. And it wasn't very good in 2023. And I'm in a room full of industrial brokers in South Florida. And these folks were like ebullient. They couldn't be more bullish on the market. And I told them all in a group, I remember saying, you're living in a bubble right now. You're just stuck in this very strong hyper bubble around the industrial markets in South Florida. But this can't last forever. And so I guess after 2+ years, I'm happy to hear that I was right back then. But I do agree with you, Juan. I think there is a certain, if you're in a particular sector, it's harder to get a big picture. I think big picture, we're going to see good opportunities for real estate, which is going to bring people back into the investment of real estate. I think there's going to be distress, and it's not going to be pockets of distress in the coming year. I think there are going to be real opportunities for investment, but I think the money's going to quickly be there. We're starting to see the debt funds chase. A lot of all the activity that we've seen over the last year and a half is in the background, right? It's on the debt trades. And on the debt trades, we're not seeing huge discounts yet.
Well, because the bankers are being little bitches and they don't want to foreclose on anything. So
Well,
they
that's
keep
about-
kicking the can down the
Kick-
road
it's
and they're
about
freezing the
60%.
market.
So I'll bring you back to the opening conversation, which is why we started talking about industrial is because it tends to lead economic activity.
Yes.
So why focusing on a sector sometimes might not be a great thing, but given the fact that industrial kind of leads economic activity and we're getting kind of hammered on all sides right now by the administration, by general consumer trends and everything. I think it gives a good lens as to what will happen over the second half of the year. Just putting that out there.
Buckle up and get your money
Felipe,
ready.
you have my leading indicator, so you know what I'm looking at.
Well, it sounds like, if we could build small bay warehouses and the numbers could work, that's where the money should go.
Build them
do it.
all day, every day.
So if-
Maybe under apartment towers, go small
Yeah.
bay.
So buy an existing small bay in East Hialeah, Alapata,
Dude, there's-
Opelika, all our markets is a sure bet, Ben.
Yeah, I'm down. I'm down.
So let us help you.
Yeah, exactly. I mean, there's so much dry powder just itching to get into the game on the sidelines. Like it's going to flood in when those opportunities come out. So
That is.
look, thank you guys again for joining us.
Yeah,
We
this is
love
awesome,
hanging
guys.
out, drinking, talking shop with
Yeah.
you guys. We'll be back for Q4.
Loved it, guys. Thanks a lot.
All right,
pleasure.
thanks, guys.
Take care.
This episode is brought to you by Built World Advisors. Yeah, that's us. We're not your typical commercial brokerage. We combine deep market knowledge with a media platform that actually connects to people doing deals, the developers, brokers, architects, and attorneys.
Let's not forget the investors, Ben. From warehouses in East Hialeah to off-market gems in Alapata, we help you find value where others aren't looking. If you're tired of waiting for opportunities to land in your inbox, let's talk.
Built World Advisors, real estate for the people who get shit done. You can check us out at builtworldadvisors.com.